Hello, folks. Welcome back. Another weekly. I'm probably going to upset a few people. It's fine. It's what I do. I'm probably going to upset a few people because obviously Solana is going to be the focus of my episode here today. And the reason it's going to be the focus simply because they're so jacked up right now. I think it warrants spending excessive amounts of time talking about what it means, because I believe, as I was reading this, I believe it may tell us what we can expect in the future, not specifically Ethereum, but just in the future overall. I believe it may get us to a better understanding about where our cryptocurrency is going to be going. For those that have been kind of like, what the heck is going on with our stuff? This might be an opportunity to take this experience, and Solana, for those that haven't followed, has had major issues for a long time, and seems like that's all they do is screw up. And so we can possibly learn, hopefully, if we're smart enough, the lessons from this business and use them to drive positive change in another direction. So I want to dig into that. The reason I say I'm going to upset some people is that I'm going to be talking, unfortunately, about Libra Miner, only because as a public service, announcement kind of thing, I want to do it as a courtesy to people. I want to make sure people are aware of what's happening with that deal with the V2 that just launched. And I want to briefly go into LUNC Classic, and briefly, ever so briefly. So at the start, let's deal with Ethereum and get it out of the way, because of course, Ethereum is kind of the go-to for everything else that we expect is going to happen. Ethereum has been in this waiver mode for a very long time. I don't expect that's going to change. In fact, I think it might even get worse. And that's fine. I'm okay with it getting worse. I'm fine with Ethereum being in the waiver. I'd rather have that than it crapping. I'm talking, 1,090. I'd rather have it be in a waiver than to complete crap. So if I go and I look at our month chart, it's obvious that Ethereum has then went down. Of course, it had the miners, MINERS, dump out, get rid of their bags, and that it's kind of been in this thing with a downward trend, expected downward trend. Long term, then, do I expect that Ethereum is going to recover? Yes. Can anybody, myself or other, tell you when that'll happen? No. We can watch the graph and we can try to predict best we can. And in many cases, that's accurate. Here's the flaw, is there are all these variables and weird things that start getting in the way, whether it's Putin saying all hands on deck for this business, whether it's the theory that the United States is sending troops to Ukraine, whether it's the crisis of inflation, whether it's the president going up on the air and saying the pandemic's over, freaking people out who are immunocompromised, whether it's the people worrying about the price of bacon. And by the way, I had booked an order for bacon, $14 if I want to buy the brand name, $10 if I don't. And it's pretty dang high. And so I see it. I see there's certainly an impression that prices are kind of out of whack. I think that's a factor playing with this. I also suspect long-term, I'm talking 2024 now, long-term, cryptocurrency in its current form is not going to be what we end up with. I believe regulation is coming very soon, and nobody knows what it'll be. I do suspect it'll start with stable coins, which is good, because stable coins, of course, are stable. But if you lose, like, let's say stable coins, let's say that there's something that pretty much requires you duly note anytime there's a stablecoin transaction. Well, if you're doing a stablecoin transaction, almost all the trading pairs, not all, but almost all the trading pairs are to or from some sort of a stablecoin. As in, let's give you an example, LUNC Classic. Today, I cannot take BNB and trade straight to LUNC Classic. It's not possible. I would have to start with either USDT or USDC, get that as a, sell out to that, and then buy into BNB. Well, then, okay, duly note, hey, you just got $10,000 worth of this stable coin to do. That's what I suspect they'll start with, is let's just know who's interacting with stable coins, because that's going to tell us where the money movement is, because the trading pairs largely are around those. That means you have to go to a decentralized exchange The problem is that even in the DX, you still have an intermediary that usually is a stable coin. Just it's the nature of what it is. Very few times will you have a trading pair that is not in some way involving a stable coin. They're there, but it's not the common. The common is USDT, USDC, BUSD, DAI, whatever is somewhere in the middle of this business. So given that, and given all the different random things that happen, we can read a graph all we care to. The truth is, the graph only tells us, given nothing changes, I'm talking dramatically, like with just the buys and the sell trends, this is what we predict. But these variables, these one-off things that keep happening, can throw a wrench in what is otherwise a normally predictable thing. So I saw a person who was doing a graph analysis, and he said, I see that we're going to be going off Luna Classic. And instead it went, and it's because all of a random sudden, Binance said, all right, we'll go ahead and do the burn on the trading fee out of random nowhere after previously saying that they wouldn't. So this person's prediction would have been accurate had that announcement not randomly got in the way that caused a pump. Now the pump, it stabilized, it didn't last, but the point is it changed the prediction. It changed what we can see. And Ethereum is the same way. My only prediction so far has been, and I'm sticking with it, I'm stubborn, and I'm sure other YouTubers will disagree with me and say I'm crazy. That's cool. My only prediction has ever been, I don't believe that Ethereum can go too much further beneath $1,000. That's the statement I've always said. I don't believe it can in my assessment. And I've targeted, if it goes too much lower, if it goes below $900, I'll do live karaoke here on the weekly, on that next weekly. That's how confident I am that what we saw this, where it got down to as far as like $880, I think was a blip and an aberration. And you notice it didn't last too long. That was right around here. Went down to 900 some odd, and there was a point where it hit 880. But I think that's a blip. It's like a kind of thing, not right. So could it happen? Sure. So far, the only prediction you will ever hear Leicester tell you is, I don't believe it's going to stay beneath $1,000 because I don't think it can, because it's too ubiquitous, especially if I look at its market cap of over 100 billion, even now. I simply don't think it can. It's not like people are going to other projects. It's not like people are dumping or selling en masse. You have miners, certainly, that are doing so. And Ethereum is now deflationary. I think that's also another factor in why I'm so confident in Ethereum. The proof of stake is going to cause some weirdness in the prediction, because if people actually use it, great, but gas prices still aren't. I mean, they're better than what they were in 2021 by far, but they're certainly not where they should be, given that it's proof of stake. So not enough time has passed for me to give you more confident of a prediction. I'm simply saying, in my mind, I'm more confident. I don't want to say bullish, just confident in Ethereum's long-term price potential than others might seem to be. And that's fine. We can all have our own different opinion. Just mine, I think Ethereum is just in this waiver period that is temporary and will eventually go back up. We just have to let time pass and see where it goes from there. So my summary on that business, just to wrap it up, is let's look at the big picture of cryptocurrency before we leap to, I've seen people talk about $700. Come on. Let's let time pass. We are seeing now cryptocurrency it's a passage of time thing. It's no longer this immediate, it's passage of, a new crypto starts up, right? To know whether it's going to crap or not always takes time. Like, you have to let it vet itself out and then watch it. We see this pattern. Ethereum is no different in the changes they recently did. And I'm simply saying, I think we need to give it a little bit more time before we leap to the judgment that it's just toast, or it's dead, or it's dying, or whatever the F. Because I think we have not given enough time and energy to this business in order to make that call. That's all I'm really saying here. Let's go ahead and talk about Solana. Let's get the bear out of the room here. Solana had a major deal happen over the weekend. This happened just yesterday. Most people might not have noticed it. I believe it's been recovered since, but it was a pretty bad, outage. And I'm going to talk about the situation. I'm also going to talk about the past and revisit what's happened before, just really quick. So when Solana goes out, right? Solana has had multiple outages, multiple in the span of a year. I would argue of every single blockchain I can think of, they have had more outages than any other blockchain possible. I can't tell you, they came out and they said, you know, we grew too fast. I think there's more to that. And some of it's around the way it's built. And I'll talk about that in a second. But it's hurt price movement. Solana at one point peaked at roughly $330 per, if I recall correctly. Let's go to all and see if that's true. Well, 200 and some odd, 258 peak, 200 some odd. And then all of a sudden, and that's because of all these different issues they've had repeatedly, constantly, consistently that don't seem to go away. It's hurt what it should be. Like if you look at the trajectory of growth, when this thing initially started building out, the trajectory of growth was substantial and it seemed nonstop. And then they started having issues, literally starting. And here's the funny thing, the joke somebody called out, not joke, but the observation somebody called out. Their issues happen on the first every time. And if you look at the graph, it is true that when the first hits on these months, that's when you start seeing some sort of a crap out each and every time, because these outages actually have consistently happened around about the first, going back. And so people are asking the question, number one, how is it that Solana, of all the other ones, keeps crapping out and the other ones don't seem to have that same disruption? Number two, what are they going to do to fix this? And my summary is that I don't believe there's anything that it can do, because I believe it's inherent to the way it's built. And I believe that seeing this is good. Yeah, I believe it's good because it helps highlight a fundamental flaw in one of the mechanisms that, if it were fixed, if we could figure out how to fix that flaw, might actually lend itself to better blockchains in the future. And remember, that's the perspective I'm coming from. Follow me here. I'm not praising Solana, by the way. I'm not. They're garbage because they keep crapping. But I'm saying we can learn from this if we're willing to. So Solana, the blockchain, uses all this different mechanism stuff in order to avert the very disaster that happened. One of them is the Nakamoto coefficient and everything else. The summary of what happened here, in a simple term, and I want to simplify it for the tech inept because it's fine. Here's where this person said, you know, it goes down the first, and it seems like it's a pattern of the first. What essentially happened at the core of this, when you have a blockchain, in order for blockchains to work, you have the concept of nodes, which are machines that are making the work happen in some way and form. In this Solana issue, one of the nodes wasn't configured correctly, and thus it did not process a block. It basically misprocessed the block. Now, the thing that made people laugh is that every blockchain deals with this. You always deal with some node is not doing it right, and then a block gets out of whack, but it's supposed to be built for rigor, that it can recover, it can work around it. It's not brought to its knees over this. It's actually a very common thing, but you're supposed to build, it's basically like a redundancy in there to make sure things still go, and you handle it off to the side, and then you work with the node, and that you would never have where just one, right? If we're talking decentralization now, one node in a network of nodes, just one can bring the whole thing down. Because think of the way blockchain node design should work. It's kind of like a spider web. If I can't go this way because this road's down, it should just go this way and go around it, if I'm doing it right. If I'm not doing it right, and it's like, right, it's backed up, traffic jam. Just like any other, like a physical deal, you cannot work around it. That's fatally flawed. That's what essentially happened. And I know it seems like, but that's what essentially happened. Here's the high level then. So that's the low level of, at the bottom line, this node was jacked up and it jacked the whole network, brought to its knees. Well, think about this. You could have a malicious actor, right? that sets up a node with ill intentions to crash the network. Do we know that's what happened? No, I don't. I'm saying it could. And if I wanted to basically make Solana useless, I would do that. I would just spin up a malicious node and kill the business. This is a problem if you know about Tor, and maybe you don't, but Tor basically think of Tor conceptually as very similar to the way blockchains work, in the sense that you have these computers all around and traffic is routed through them for anonymity purposes. But one node, if it goes down, it'll just redirect the traffic. The concepts around this strategy are not specific to cryptocurrency. In Tor, the concern always had been that you could have a malicious actor here that intercepts traffic purposely so to collect information about the sender and then transmit it to authorities or something else. It's always been a risk. It's a risk you take if you use Tor. In this situation, you could have a bad actor who spins up a node purposely built to fail, like purposely misconfigured to fail, to bring the network down because they know it's an issue. It's essentially an attack because of the way that, if you've heard me before, I said we don't really have decentralization. Now, that was your aha, right? You heard me say it. We don't really have decent. It's a myth. It's not true. It's not factually accurate. We don't. This is why. However, this situation can only happen in one specific setup, which is what they refer to as proof of history. I'm not going to bore you with details. Proof of history, other than proof of stake, other than proof of work, proof of history tries to get away from thinking about the time something happened and simply focus on a sequential set of events that should lead you. If I start at a certain point and I know it takes X to process one interval, I should end up in that same place without having to care about calculating the time. I simply will end up in the same place because I know. Let's take the simplified example. If I know that I need to walk somewhere and I know that my pace of walking, I know how many houses I'm going to walk past, and assuming the houses are the same or similar size, let's assume, I should be able to calculate how long it takes for me to walk past each house. I should be able to then know because it's the same route, I'm going to pass 10 houses. So I should be able to calculate exactly what that duration of time is. I don't have to then preemptively say, I should end up here in 10 minutes. I should be able to just live calculate it, and then it'll be 9.87 or 10.12 or whatever. It's an actual deal. Should be more accurate. Problem is, the assumption is that I have the segments are roughly equivalent or predictable. That's probably better said. And if they're not, then my calculation gets all out of whack. I get screwed up, right? Because I'm making the assumption I'm going to walk by 10 houses. I'm making the assumption they're all the same size. I'm making the assumption that a house won't collapse or expand the next time I take a route. I'm also making the assumption that the sidewalk hasn't been jacked up. I'm making the assumption the road hasn't been closed. In this situation, I'm making an assumption rather than a calculation. So I'm assuming all of these factors are all good to go and that I should be able to take a path and I should be able to be good. If something else deviates, my assumptions are flawed. I no longer can trust my estimation of duration of time. So if that happens, I can no longer assure back to the other node, the other side, when they should expect something, when something's going to happen, back to the client, when this is going to be completed. Everything grinds. And so the takeaway, and the reason I think it's a good thing versus a bad thing that this happened now, and that we're seeing this consistently break if they can figure it all out, which I think they can. It's just going to take make more time, more effort, more energy, more thought into what we're trying to solve. Theirs was simply trying to not have to care, because you have different time zones, you have daylight savings nonsense, you have all this variation in trying to do a thing, and it's inefficient because you have to add all these layers of redundancy in order to be able to deal with it, which is our current state of blockchain management. Is everything is built to make sure it runs, not necessarily that it runs efficiently, which is why, in my opinion, proof of work has largely been looked at as the most reliable way of getting stuff from A to Z. However, it's expensive because of the way it has to do it. In proof of work, when your transaction goes, you want to do something, multiple validations happen against it. I want to make, there's layers and layers and layers of validation that happen to make sure the integrity of the data is intact, to make sure we can trust the data from A to B. That these other ones, proof of history, proof of stake, they took a different approach in it. Proof of stake has some of that layering, but nowhere near the level of complexity that proof of work does for that reason. It's a very fascinating set of thought, and I do challenge you as a call to action to do your own research and look into really the difference in how we do the transactions. Why do I think it's that critically important that you understand it? Because whatever we settle on, and I don't know that answer, is going to set the stage for regulation. Because at some point, they're going to target a standard. At the end, I don't think it's going to be about a token or a coin. They're going to target a standard. And they're going to try to define rules around the standards by which those coins and tokens are distributed, are managed, are duly noted, are recorded, are the integrity, because the goal will be to make sure we don't lose money. Because everything regulatory, at the end of the day, ties around fiat. So they're going to say, whatever we choose to do, it needs to make sure we do not do everything you can not to lose money. No different than a bank that has layers of people who all together have access to open that vault, and layers of tracking of who went in and who went out, and layers of camera in order to watch who went in and went out, and layers of checks and balances at the cashier level of how much money I gave you in the morning and how much money I ended up in the end, and the transactional details that caused debits and credits, all the way to your ATM machines, from the person from Brinks who loads the money, all the way to the security guard that watched him do it, all the way to the cameras that watch somebody that interacts with it, all the way to the software programmer who programs the software. Layers and layers of protection. I'm saying, I believe this incident highlights this over here in proof of work had the right idea, but it's expensive because it has to be in order to ensure the integrity of transactions and continue running. Proof of stake is less expensive, but what do you lose? Proof of history is way inexpensive, but what do you lose? And regulations are going to look at these standards. And then whichever tokens follow, whichever standard is most compliant with the regs is going to be the ones that get left alone. That's why I think it's intriguing to watch it and be aware of it and be in the loop and really study it. I know it's boring, but I think it affects you. It affects you in a very important way. And if you don't watch it, that's up to you. It's your money. I'm saying that no matter what country, like this isn't a US thing, because if the US does a thing, other countries are going to follow them. So mine has always been, okay, this is interesting. This is fascinating to me. They might target the protocol, not the token, because it's not really about the token. It's about the risk of loss of wealth. Proof of stake is just a convenient thing because staking generates a ROI, an expectation. So there's a tax interest, but there's also this loss of wealth interest on a totally different regulatory arm where they want to make sure you don't lose your money. That's a different consideration. In certain cases, like say Bitcoin, I'll pick on Bitcoin. As proof of work, you can't really lose your Bitcoin unless somehow your wallet gets breached. And your wallet would only get breached if you A, connected to a malicious actor, B, you gave your private key or your mnemonic to somebody, or C, your Bitcoin was like staked somewhere and that whatever got breached. Like I don't know if Voyager did it, but some of them certainly allow you to stake your Bitcoin and get rewards off it. Like you would have had to actively take a step to expose your Bitcoin to somebody else in order to get a breach. Your Bitcoin's not getting breached if it's only ever been that you went to Coinbase, you bought the Bitcoin and you sent it to your private wallet and you never did anything else with it. It will never, and you never gave the keys, you never exposed the mnemonic, you didn't write it down. It's literally impossible for it to have gotten breached just sitting on the blockchain. It's not possible. For them to calculate and guess your private key is virtually impossible. Could they guess your mnemonic? Sure, but it would take them like 100 years to figure it out. It's literally I'll say it, I don't care who disagrees. If you didn't do anything with it in your private wallet, there's no way it can be taken. However, in a proof of stake world, first of all, when you stake it, you are essentially exposing it in a way. If you bridge it, you are essentially exposing it in a way. You're taking an action that makes it exposed outside of your control. That's the difference between these. With these different proof of stake, proof of work, proof of history, etc., the way that exposure, what's the exposure vector, changes. And I believe, this is me, they're going to look at that, and that's where they're going to target their regulations, is around exposure to risk, because that's what they're supposed to do. That's their job. How exposed are you to risk? I argue myself today, right now, Bitcoin has the lowest exposure to risk inherent to it, because it doesn't allow you to do those things natively. Somebody could spin up a tool that kind of cheats it, that could get breached. Well, you'd have to take the choice to do it. Why would you do that? Greed. You're trying to make money off your money, which is smart, but that's risk. You're exposing yourself to risk. It's no different, frankly, than stock. Because you could, if you lent your stock out, options, right? If you lent your stock out, you have the same risk. The risk doesn't go away. And I think people haven't reconciled. The risk vector is what's the new era, is looking at risk and figuring out what's different in the risk here versus the risk there, and what regulations are going to minimize or mitigate that risk long term. That's the fascinating conversation that I challenge you to understand so that you can make smarter decisions from a risk management perspective in your portfolio. Because maybe you avoid certain tokens because of higher risk, or maybe you go all in because higher risk, higher reward, or maybe you simply avoid them. Then it's up to you, and you have the power, and you're not dictated to by a Voyager of the world or whatnot. Now, I'm going to apologize because I got to breathe a sigh of frustration because as a public service to people who follow the channel, because I know some do, that came from LIBERA, I'm going to talk about it because they suck at communication, number one. Number two, I saw they started forcing people to telescam, and I think that's crap. And I don't want people to get confused. Apparently, according to the team, Crypto Talk Radio doesn't know what he's talking about. This is our test. They've recently launched the BUSD Miner V2. As far as I can tell, they didn't V2 the token, just the actual application. To me, the website still sucks, but whatever. To high level explain what the difference is between the original one that was there and the V2 that's here now for the miner. They took the concepts that are on Ethereum and they added it over here. However, there were a couple of things I saw. Not only did I laugh at it, it's almost insulting. In Ethereum, when they launched it, they said, go ahead and connect your wallet and we'll give you $25 to start trading this right now. To basically, it'll $25. You don't need to do anything other than join, connect your wallet, and we just deposit $25 straight off scratch. For LIBERA, yeah, we'll give you $1.17 to deep. Why you would even waste, think about this. It probably cost them more in gas to give you $1.17 than to just not do it. Like, this is beyond bubble. When I saw this, I couldn't imagine why. I know why. It's because they're not listening, but still, like $1.17, really? You're really telling people that it's okay to take this $1.17 and you think it's going to convince people that this is worth their time, that it's worth it other than, and I know they said, well, yeah, but look, if you deposit $50, look what you can get over here. I'll get to that in a second. But still, $1.17, if you can afford to do $8 grand for the win it now, and by the way, I'll get to this where it says Binance USD. Nearly $4 grand from the largest depositor, $200 from last depositor, and this 23, which is basically not true. If you can afford that, you're telling me you couldn't give more than $1.17 when on Ethereum, which has half the market cap, you were able to get $25 up front. It's gone down now because Ethereum went down in price and BNB slightly went down. So it's like $22, $21. It's still way more than $1.17. Anyway, I don't know who this joker is, whatever. So then this win it now, largest depositor and time pool. Largest depositor is what they had before. The replacement for what it was before. And there's my breakfast here too dang early. Time pool deposit. Time pool deposit is a new concept. Basically what happens is as people deposit into the thing, it increases, and then you have to deposit at least a thing. It's basically a race to the top. And then Win It Now basically says, you know what, screw it. I just want to give you, and in this case, it's this. So give you $6,000 and we'll give you an extra $8,700, which I frankly think is a ripoff, but some people might actually want it. That's fine. So they're trying to highlight, there's 3 ways to win now. Cool. Here's the problem. It all says Binance USD. All of these say Binance USD. Okay. Well, we learned from the previous that it was not actually Binance USD, because if you look, this is a value equivalent of Binance USD, not Binance USD. What's the difference? All of this is liquidity pool. LIBERA is paired to Binance USD within the liquidity token. The problem is that because LIBERA is crapping in value, the total value of the pair goes down. So let's take this person here. This person here's value at one point was probably about $4,700, $5,000. But LIBERA's been crapping because it's wrapped Libero and Libero's crapped. So on the day they won that, the value of it was higher than now, because it's not truly Binance USD you're winning. You are winning the liquidity pool token, and the half of it is crapping. It's going down in value. So that's the issue. Is that, okay, you get more, you're basically getting more crap because it's still paired to a crapping token, which isn't the right answer, but that's what it is. So anybody that goes in this deal, the value, the total value locked, which is TVL, you see them talk about that in different places, is constantly going down. The total value lock's going down. Your value that's in there is going down. If you wanted to go in and do this, it does indeed pay you. It does indeed give it. These get deposited into your accumulated, which I don't know if it'll let me show because I'm not connected and refuse to. There we go. It goes in here, not in here. Because it goes here, all it's saying is the total amount that you're eligible to generate a max payout for would go up. So if you were to, let's say you won 8,000 USD, which is really the liquidity pool, $8,000 today in value. That's going to calculate a max payout. It's probably going to be somewhere in the neighborhood of like 18 grand or something like this. That doesn't mean you get 18 grand, doesn't mean you can withdraw 18 grand. It means that the total amount that pays is 18 grand. So then your daily return, which isn't the amount you cash out, it's return, is, let's say, in that probably 130 bucks daily. It forces you to compound, not forces, but essentially forces you to compound for 6 days. On the 7th day, you would claim, and it would be that 130 bucks or whatever it is. So it's like $130 a week in that scenario. So the thought behind this that people didn't understand, and I saw somebody on Twitter and he sent a screenshot and said, I only get like $2. And it's because he ran out, because he only did one deposit and he ran out of his max payout. He's running out. So it's dropping his daily payout. Now he's down to $2, because the assumption here is you're just whaling in. You have to make sure this amount is constantly growing, which then essentially grows this amount. This is how much you put in. So either you put in, whale in, or you do it to win something so that your accumulated goes up, which then it increases this, which just says, I'll keep paying you a higher daily over X period of time. So the thought here is whale. I'm whaling. I'm constantly investing in. I'm constantly investing in. What people assumed it was is I do one time and I'll throw 200 bucks at the deal and I'll get 600 Binance USD. And it'll just keep paying me. No. You have to keep paying in if you want it. Like, I'm not saying it's not, I'm not a fan of this miner because you can't extract what you deposit. I'm saying that if you're going to do it, understand what it means. If you're going to benefit from it, it wants you to whale into the damn thing. And if you're going to whale in, you might as well just do the win it now because you're already a whale. Well, yes, that's asking, in this case, $6,000 of you to get $8,000. Sure. And if you were to do that at some point and keep doing it, like literally whale in, at some point, your accumulator to be so high, your daily return to be so high that your once per week payout might be higher than some people's work salary, right? You could get to the point where you're making, $500 a week. Well, $500 a week, 24 grand a year. Certain people in minimum wage don't make that. And it's just passive. You don't have to do anything. It just is what it is. The downside, they're paying you in a liquidity pool, not Binance USD, which means it will lose value. It's depreciating because Libera is crapping and Libera is part of the pair. So, summary, I'm still not Miner fan. I understand the changes they made were simply to make it consistent with Thorium's. Fine, but this is a joke in $1.17. That's a joke. This is whatever it does on the Thorium side that people might be okay with. And this didn't change. I mean, it did. It went up slightly, but not really, because again, this is liquidity pair as it was. It's a little bit clearer. That's about it. And then, of course, the time pool is somewhat new because the time pool is a race. It wasn't there before. And so that at least gives some people the opportunity to win something a little bit easier with less investment than with this business here. So if you're interested in the miner, it's what it is. I would argue, though, I still say Thorium's seems like it's just more of a smart option because Thorium's whole business, although it's the same structure, again, if you did it the first time, they give you $22.50 at no charge deposited into the miner. So right there, it's a better deal. With Thorium's, it's the same struct with these, like same amounts, raw amounts. The difference is Thorium is not a wrapped token. So since it's not a wrapped token, it means that it's likely going to appreciate faster than Libera will. And this is a V3 token. So Thorium, because you're getting a liquidity pair here too. You're not getting BNB, you're getting the pair, the value of the pair. But Thorium is not crapping because it's not wrapped to a crapping token. So the value is more likely to appreciate than with Libera because Libera is wrapped Libera, which is crapping. Summary, I'm saying, if you're going to go into miner, I'm going to recommend Thorium's based on what I see as more long-term valuable because of the way it's built. It just feels like Thorium's is what Libera's was intended to be, but because they had already wrapped it, it was already too late. And then they're just like, screw it. Like if they were listening to me and they claimed, by the way, that Crypto Talk Radio doesn't know what he's talking about, and you've heard me talk for a while. If they were listening to me, I would have told them, take everybody who's in Libra Miner today, everybody who went in, I don't care if you whaled, I don't care. Take everybody's stuff, convert them to Thorium's miner, and get rid of Libera's miner. Just get rid of it. Totally get rid of it. It's a failure, but don't let them lose their money. Just take their money and equivalent over here to basically swap the liquidity pair token over to this one. Tell them, we're going to put you here. This is our only miner because I'm fine with it being on the Thorium side. Thorium is kind of this capital company. No problem. Do that. Then tell people we are not doing anything on Libera. We're going to work on Libera. I would at this point do a V2 Libera, the token, to try to fix its problems and get it back to some stability. I would let people withdraw from the banks with no fee if they want to. And I know you're like, well, it's because, think about it. If you leave them in there, all you're doing is pissing people off. Sentiment's harm. When sentiment's harm, you're not making it any better. You're making it worse. I'd rather just let people cut and run that want to cut and run. But the people that are in the Libera miner, I'd move them to Thorium miner with the equivalency of the Thorium liquidity token and say, this is our only miner going forward. Libera will not have a miner. Libera will not have a miner. Then I would enhance Thorium miner in what you can get in the payout. So when you do the claim, I would give people the option to unzap to BNB, unzap to Binance USD, unzap to Libera, unzap to Libera, unzap to MVC. Like I would literally say, you can now leverage anything that you want off like the miner can pay you anything you want. Why? Because if you do that, you're telling people, we want you to own these things. We want you to hold them. We want you to have them. We don't want you to sell them necessarily and accumulate them, because we are going to work to revitalize them and revitalize the ecosystem. That's what I would do. Like, I would use thorium as literally that central point of everything that makes everything else more valuable. Get rid of Libra Miner because it clearly is a failed experiment, in my opinion. Don't do it. Just do a miner here only. I would let anybody automate. It doesn't matter about how, like right now, you have to have $1,000 in there. No, anybody can do the automate. Just understand, we are going to tell you with the fee. That's fine. And if you do automation, it's just going to be this, and then you'd have to do the unzap to one of the other options. Can you think of how powerful that is? Like, you literally could turn this thorium miner into a true miner, as in it can mine everything in the ecosystem. Now you're adding value back to everything that's there, instead of what it is in the Libera side, which is just this isolated thing that's losing and crapping in value. But again, Crypto Talk Radio apparently doesn't know what he's talking about. So I'll let the community decide. Let me know if I don't know what the heck I'm talking about, and then we'll kind of go from there. I'll wrap up because I got to get my breakfast. This is the episode, the first episode, where I said we're going to be doing the LUNC challenge, as I call it, and I'm the only influencer so far that's on board. That's cool. I'll do it anyway. What I'm going to do is I'm going to take these stats from this that we're doing here, and I'm going to do my calculations, and then next week, live, you will see me send that amount of Luna Classic tokens to the Burn wallet. Because again, for me, the YouTube channel, the podcast, none of it. These are not built for profit. They're built for community. They're built to interact. They're built to share information, because I'm a podcaster, number one. So I'm going to contribute as a community member for Luna Classic by doing the LUNC challenge. And if I'm the only one that does it, cool. Because here's the thing. Some of the other ones, they talk a good game. Geez, I saw one of them. I'm not going to add him by name because he's not doing anything wrong. It's him. It's his business. That's fine. But he probably tweets more about freaking LUNC challenge, Luna Classic, than anybody else out there. Of just, yeah, it's going up. We're going to it's going up, man. I'm all in. I'm out of, and then I saw, and I will call him out because it's benign, but Rodney, aka Fudney, I guess, right? Crypto Journeys. He came out and he said, I'm just holding it till 10x. Cool. All right. I support that. It's fine to be a holding supporter, right? It's fine to, yay, we're getting there. Question is, can you put your money where your mouth is, which is contribute to the burn, not just the 1.2%. Are you willing to contribute to the burn, or are you just holding your bags because you want to be enriched? If you just want to be enriched off the backs of everybody else buying in, basically creating a pump, cool. I support you. I respect you. I celebrate you. I'm showing a different path. And hopefully those that watch my channel and listen to Leicester at cryptotalkradio.net will see he's doing it different. He actually is. He's about it. He's one of, like the kids like to say, he's about it. He's one of them. Because he's contributing to the burn. He ain't doing this for profit reasons. He's willing to burn. All we got to do is simply show up. Because notice, none of these say that you have to like it, the video. None of these say you have to subscribe. None of these say you have to share. None of these say you have to do anything other than be here. Be here, and if you want a little bit more, send a message. But other than that, you don't have to do anything else, because I'm not asking the community to really do anything other than show up. And watch me do what I do. Watch me now. Hey, work. So with that said, I'm going to shut up, check for any comments, get my freaking breakfast, and then wrap up for the day here. And I'll check Twitch too, while I go grab this business. That driver showed up way too freaking early, because I told them to show up at 9 o'clock, and they always do that nonsense. All right, nothing in Twitch. Good. And looks like nothing on YouTube side. Awesome. Good enough. If something comes to you, feel free to leave it in the comments below. Again, that will be added to the tally. The tally goes pretty much through the span of today. So I'll add it to the tally, check all that stuff, and then I will prepare my tokens for the burn. I already have the wallet ready to go. For that, if you think of something after the fact, I want to thank you if you listened here live. I'll thank you if you're listening here after the fact. And we'll be back next week again, same bat time, definitely same channel for a little bit more that's going on in the crazy world of cryptocurrency. Until then, I want to thank everybody, by the way, that's holding the line. I mean, remaining sane, right? Of not losing your mind or getting pissed off or contemplating suicide. It's not worth it. If you start feeling that because you just don't know, get out of it, right? Don't stop staring at graphs, stop staring at the wallet. Just go do something with your family, spend time with somebody else. Don't get caught up in this because it's tempting. It's hard, but I don't want anybody to get knocked off the fence because things are not what you want them to be. It's not worth it. It's just a thing. It's a phase. This too shall pass. Spend some time outside, spend time with your family. Most importantly, make sure there's a roof over your head. Make sure there's food on your table. Make sure your people are taken care of first and foremost. Don't get caught up in this stuff. Next week, I'll see you guys.